Carnival just posted one of the strongest first quarters in its history. Record sales, record yields, record deposits, and on paper, this is kind of the quarter that should send the stock soaring. And as a investor of Carnival Corporation, I'd have thought at least it would have had a nice positive reaction on the earnings release. But instead, Carnival was down 20% year to date, and that disconnect is exactly why we're breaking this down today. Because when the fundamentals say one thing and the stock price says another, there's normally where's an opportunity or danger usually hides. Now, stick with me because by the end of the video, you understand not just why Carnival reported, but why the market reacted the way it did, and whether the action makes sense. Now, before we go any more in detail, I'm not a financial expert, I'm not an advisor, so please do your own research. I am just covering stuff that I feel like I do in my own time, and I want to share it to you. I may not be good at it, I may not be the best at it, I am trying to learn at the same time. So if you do have any feedback, comment down below, leave a like, hit the subscribe button, it just supports the channel out, and let's dive into it. So Carnival Corporation, it does engage in the operation of cruise ships. It operates through the following business segments: North America cruise operations, Europe cruise operations, cruise support, tours, and others. Now, the North American cruise segment, it normally includes the Carnival Cruise Line, Holland America. You've got the Europe, who, if anybody in the UK, especially if you live down in Southampton, you see the ships like Queen Mary and all that, they are based on Cunard or the P&O cruises. Of course, Carnival do own that. Now, I have put it does own the operation of cruise ships, but actually they're actually going into a little bit more of just cruise ships. They're actually doing private islands, which we'll cover later on in the video. So, Carnival Corporation is based in the United States. The price of time recorded is about $24. Market cap of $33 billion. IPO was in 1987. At the minute, it's roughly about 160,000 employees. There's no dividend growth streak because the dividend's only just been restarted, and that is at 2.48% due to the price downfall. So, why does this stock hit so badly? Well, I'm not quite sure. They've only just restarted the dividend, which is at 2.5%, and investors are still cautious due to that. So, this is what happens when a company is in recovery mode. The market reacts more aggressively to any sign of risk, even if the core business is improving. Even though Carnival Cruise Line for families to Princess for premium travellers, Cunard for luxury, they built this portfolio that is very diversified, that captures a lot of demand across the whole cruising ecosystem. And due to that, this quarter wasn't just good, it was historic. Carnival hit records across revenue, net yields, operating income, customer deposits. Like Jesus, it's not just doing good, it's doing amazing. And record deposits are especially important. Deposits are future revenue already locked in. They're forward-looking indicators. They tell us that the demand isn't strong, it's accelerating. Now, when a company breaks records in both current performance and future bookings, this normally is a sign that business is firing on all cylinders. And it even outperformed every guidance on every measure. Carnival just didn't beat expectations, they beat their own. Net yields came in higher, costs came in lower. The EBITDA beat guidance, the net income beat guidance, EPS beat guidance. This kind of quarter analysis love because it just shows that they're doing so well in their operational discipline. It shows the management isn't just optimistic, they're executing. And as an investor myself, this is a good thing to see. But we'll see in a second why the market was just focused on the past. It was focused on why Carnival said about its future. Now, the demand is the heartbeat of the cruise industry, and luckily, Carnival demand's picture is incredibly strong. Net yields outperform guidance by over 100 basis points. That's pricing power. Onboard revenue is growing. That increases margin expansion. And pre-cruise spending is accelerating, and that is the customer engagement growing as well. And deposits hitting over 7.9 billion, up 10%, tells us customers are booking earlier and spending more. This is exactly what you need to see in a travel recovery cycle. And with over 150 million operational improvement on the bottom line, is the best thing ever. Even those improvements, rising fuel costs created over 500 million in headwinds. That was a massive drag though. And this is where the market started to get a little bit nervous, because while operations are improving, external factors like fuel and geopolitics are eating into its bottom line. This is a tension that's going to define Carnival's 2026 story. So despite having the highest ever booking levels, the bookings are the strongest they've ever been. 2026 sailings up double digits. 27 beyond record levels. 85% of 2026 was already booked at higher prices and higher demand. This is unheard of in the cruise industry. It shows that cruising isn't just recovering, it is absolutely booming. And when a company sells out of inventory early, it gains its pricing power. That's how margins expand. And the thing is, capacity growth is measured. One of the smartest strategic decisions that Carnival had made was controlling its capacity. They're not flooding the market with these new ships, they're pacing themselves. They're doing something that they should have done a long time ago, focusing on profitability over growth. And this is what matters because the cruise industry has historically hurt itself by overbuilding. Carnival is avoiding that trap. Measured capacity means stronger pricing, better yields, and more stable earnings. And they're also going to do this. They're going to monetize destinations. Now, like I mentioned briefly at the start, they aren't just focusing on cruise ships, but this is one of the most underrated advantages that Carnival has. And it's private islands, like Celebration Key, their exclusive lodges in Alaska. They aren't just pretty locations, they're the high margin assets. Stuff like Royal Caribbean that have on their ships, they're doing this for the islands. They're doing something different. So when Carnival owns a destination, they control their entire customer experience, and when they control the experience, they control the revenue. This is how they differentiate themselves from the other cruise companies and create pricing power that lasts. They even have a balanced capital allocation. From 2026 to 2029, Carnival expects over 15 billion in capex and around 14 billion in shareholder returns. That's a balanced approach. Reinvest in the fleet, strengthen the balance sheet, and reward shareholders. Net debt to EBITDA is falling from 3.4 to 2.75x, which shows real financial healing. This is the kind of long-term planning that builds investor confidence, as well as making sure that dividends and buybacks are coming in strong. And they are. 2026 marks a major milestone. Dividends are finally back. Over $800 million expected this year, and on top of that, a $2.5 billion buyback program. Buybacks only happen when management believes that the stock is undervalued, and reinstate the dividend signals that Carnival see itself as financially stable once again. And this is a turning point in the recovery story. But why so negative reaction? Now, given everything we've seen so far, you expect the stock to be up, not down. But the market zeroed in on one thing in the guidance. Revenue guidance was fine, but EBITDA and EPS guidance came in lower than expected. In today's market, where investors are hypersensitive to margins, that was enough to overshadow the record performance. But it's off to a strong start, though. Well, it is, but fuel and geopolitics are dragging it down. Carnival acknowledged the rise in fuel costs and the tensions, especially in the Middle East, and are starting to soften booking confidence. The thing is, higher fuel costs are pushing cruise prices up. Crude oil prices have traded over $100 a barrel. This isn't a small issue. Fuel is one of the Carnival's biggest expenses, and the risks affect itineraries, demand, and consumer confidence. This cloud is hanging over otherwise a sunny quarter. Because Carnival doesn't hedge its fuel. So this means when oil spikes, Carnival feels it instantly. Where, if you compare this to Royal Caribbean, it hedges it. It hedges fuel. So Carnival earnings are more volatile and volatility is expected when the market punishes. So Carnival doesn't fuel hedge, it pays a current market price, which is a high risk, high reward. So it's exposed to more fuel price swings. When the Royal Caribbean uses fuel hedging, it locks in price early and cost stability, so trading stability for savings. So this is the problem that Carnival has compared to its competitors. So where does Carnival leave itself? Well, the company enters the rest of the year with strong demand, record bookings and improving operations, but low EPS guidance. rising fuel costs, and the uncertainty in the Middle East created a mixed outlook. Overall, the near-term trajectory for CCL remains cautiously optimistic, but dependent on the stability, fuel costs, and developments in the Middle East. Personally, this is not financial advice, but I'm going to continue dollar cost averaging into this company because I think this long-term fundamentals look strong and the recovery story is still unfolding. And I still think that Carnival Corporation has a long way to go. If you found this breakdown valuable and you want to see more deep dive analysis like this, then check out the links in the description. I've included some resources and stuff that you can check out, especially on my Buy Me Coffee page, which I do stuff for free, so support is only optional. And if you want to see more, then of course leave a like, hit the subscribe button, comment down below if there's any other companies or stocks you want me to check out. But thank you for watching, and I'll see you on the next one. Goodbye.